Hi, I'm Crystal Stranger with Tax, and I'm here to share some of the tax knowledge I have and you need. Be sure to subscribe and give this video a big thumbs up. So today we're talking about tax treaties and C corporations. So tax treaties are something that I find are highly misunderstood by both practitioners and individuals. There's a lot of information that's written in the treaties that in later parts of the treaties can be kind of rolled back or not really apply. But there are some specifics that are really important and can give a lot of value, especially to corporations. So one of the important things is the permanent establishment clause. This is something that's in almost every tax treaty, and it states that, generally a company will be taxed when you have a permanent establishment operating in a country. So this is like for foreign corporations that come and operate in the US. When they have that permanent establishment, then they're taxed in the US, but otherwise they wouldn't be under the treaty. That does not apply to US companies that are operated outside the US. That would not be a permanent establishment. That would shift the taxation to only be in that other country, right? So that's what gives the clause to the US Treasury to be able to go after foreign corporations and get that income tax from them. Another really important thing to note where treaties apply a lot is in dividends and interest and royalty payments that are paid from a US corporation to a foreign individual, right? And there's a lot of discounted treaty rates that are applied in different ways. And most of these, if you're applying a treaty rate on one of these tax-free payments, you're going to need to file Form 1042-S to report that amount to the individual and 1042 to reconcile those amounts later. And it can be tax-free or reduced rate depending on the actual treaty. And it varies a lot. There's no consistency at all across the board on this subject. So for example, interest is tax-free in Canada, Czech Republic, and Denmark. Royalties on patents are tax-free in Austria, Belgium, and Cyprus. Royalties on copyrights, which are totally different, are then tax-free in Austria, Cyprus, Czech Republic, Denmark, Finland. So I'll put a list of some of these countries down in the notes here to help you guys out. You always want to double check this information. This changes really rapidly. Always look at the most recent treaty for the country that you're dealing with before you actually file this. Again, that's filed on 1042-S and 1042 to report that treaty amount. If it's filed properly like that, then the individual who receives the payment or the company receives the payment doesn't need to file a 1040-NR or 1120-F to claim the difference in withholding, right? One last note, though, about treaties is always read the savings clause and what it applies to in there, because that savings clause is that portion I mentioned that a lot of times clause back some of these other provisions. So don't go reading the treaty and think everything is tax-free, because that's how it sounds in every treaty, because there are those clawback provisions in the savings clause, and you really sometimes need an expert to be able to understand and see what does or doesn't apply in a specific treaty. So anyway, thank you so much for watching today. Need help with taxes? You can visit us at Cleer.tax today. Cleer is your tech-forward financial solution for startups and growing companies. Please remember to subscribe and give this video a big thumbs up. Thank you.